Hello and welcome. Moss Adams is pleased that you've joined us for today's webcast, Year-End Tax Planning for the Construction Industry. And before we begin, I'm going to play our housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, today we have with us Michael Hurst, partner here at Moss Adams. His bio and contact information are located in your webcast console for your convenience. And now I would like to turn the floor over to Michael to get us started.
Thank you, Amy, and welcome everybody to today's webcast, Year-End Tax Planning for the Construction Industry. My name is Michael Hurst, tax partner at Moss Adams in our construction and real estate group, and I sit in our Tacoma office. And I have to be honest with you, this is my absolute favorite time of year. Christmas, eggnog, and 'tis the season for tax planning. So with this presentation, we'll do our level best to be more like Santa and try to find some tax saving presents that you can wrap up, put under your tree, and open up in April when it's time to file your taxes. And we will try to stay away from some of the Grinch-like provisions that you may see throughout this presentation. So with that, there's a lot to cover, so we'll dive right in. So our agenda for today, we're going to talk about tax planning and the status of affairs for 2023. Where are we now? What's going on in the legislature? What is Congress talking about for potential tax changes in the near term? And what's sitting over the horizon and out there a couple of years so that we're well aware and making informed decisions about our tax strategy. We're going to talk about some of the things that are current law of the land that have been changed from 2022 that are in effect for 2023. There has been a lot of talk about this, and I'm sure many of you have heard over and over about the employee retention tax credit, but this continues to be a changing and evolving landscape and continuing to get guidance from the service. So we're going to tell you some of the latest of what's going on with the ERTC. We'll touch a little bit on the R&D tax credits and some of the changes to R&D expenditures that you'll need to be aware of and how to plan for those. A couple of tax incentives that came out through the Inflation Reduction Act and some of the changes that happened to those for 2023. So we'll cover those. And construction tax accounting presentation would be complete without an overview of your methods of accounting for tax purposes. Again, a lot of opportunities in there for tax deferrals and tax savings. And then, a little bit of information of what's currently going on at the Internal Revenue Service, some of the changes there and what we're seeing in practice and how that may impact you. So that's what we're going to talk about today. And we will keep going, diving right in. So, what's going on with the legislature. So I'll try to keep this as politically neutral as possible. But as you're probably well aware, tax law originates out of Congress, and Congress doesn't seem to agree on much. So these kind of what's on the horizon or being talked about for tax changes does fall typically around party lines. So again, trying to be politically neutral, but I've organized these around kind of the Republican and Democratic priorities. So what we would say as the Republican priorities that are driving tax policy is really what we're calling the business big three. So if we go back in time a little bit, at the end of 2017, the Tax Cuts and Jobs Act was passed. Great tax breaks came out of that. But now we're kind of in the period, and starting in 2022 and moving onward, where we're seeing some of the provisions that came out in the Tax Cuts and Jobs Act starting to expire and starting to have some unfavorable tax outcomes for taxpayers. So there's really three that are kind of in flux right now that have had some changes that the Republican side are looking for extensions. So the first one is kind of, and we'll get into some of the details of this a little bit later, but around how expenses allocable to research and development or research experimentation costs, how those are treated. Prior to 2022, a taxpayer used to be able to deduct those in the year that they incurred. And starting in 2022, you have to capitalize those and amortize them over 5 to 15 years, depending on the nature of the R&D. The second of the business big three, it relates around businesses' ability to deduct their interest expense. So in the Tax Cuts and Jobs Act, there came out with this rule that says you can only deduct your interest expense to the extent it is equal to or below 30% of your, let's call it your tax EBITDA, earnings before interest, taxes, and depreciation and amortization. So that would give you a number. 30% of that is what you could, the amount of your interest expense you could deduct. In 2022, the DA fell off. So now that there's no more ability to add back your depreciation and amortization expense to figure out that floor to apply that 30%. And so that is making it harder to, more limitations to deducting your interest. So the Republicans kind of have rallied around a Save the DA campaign to be able to continue to have more ability to deduct interest expense. And the third of the business big three is 100% bonus depreciation. So, we have been, living pretty high in the hog for the last few years for our ability to accelerate depreciation through bonus depreciation. So qualified assets, put them on your balance sheet, take all the depreciation in year one. So as we'll talk about a little bit later, that has started to phase out, and we no longer have 100% bonus depreciation expensing. So they want to reinstate 100% bonus depreciation. So next to each one of these is the price tag for a 2-year extension. And you can see to the extent these were extended for 2 years, which is the Republican goals right now, it would cost right around $50 billion. On the other side of the aisle, so to speak, what the Democratic priorities are right now, they're driving tax policy, is really more around family focused. So they want to reinstate the advanced refundable child tax credit. And so if you remember that, to the extent you were eligible for a child tax credit, you started getting monthly payments ahead of time, and then there's a reconciliation on your tax return when you filed. So they want to bring that back into the fold. And they want some enhancements to the earned income tax credit. So, and you can see the lofty price tag of those being around $460 billion if they were to get the priorities that they wanted. So you can see we're pretty far apart when it comes to priorities and the amount of spend. So where does that leave us? Candidly, the outlook for the business big three and any changes to that, it's bleak. So, again, you have a seemingly divided Congress that doesn't particularly like to work together. We're running out of days on the legislative calendar to make changes, at least in the current tax year that we're in. I'd say, kind of said jokingly here, House Republicans are focused elsewhere other than taxes. There's other things that you can see the news, read the paper, and kind of what some of the things that have garnered their attention recently. And, candidly, within not only do you have Republican priorities and you have Democratic priorities, right now, where they've landed as far as anywhere on negotiations, to the extent the business big three moves forward, the Democratic Party would want at least an equal amount of family-focused tax relief. Again, so the child tax credit. So you're looking at about $100 billion cost to the government in that realm, and you've got within the Republican Party, you have a lot of folks who are focused on debt and deficits, and so they expect they're really the political will to continue to put these type of things on the national debt and add to the deficits is definitely shrinking. So when you put all that together, the outlook for changing near-term change of tax legislation is probably slim. And then the other key thing is no one really brings standalone tax legislation on the House floor or for debate. So typically you need tax provisions need another bill to quote hitch a ride to get to the House floor. And again, with a divided Congress, really what we're only seeing is kind of must-pass legislation that ultimately makes its way to the floor. And fewer of those opportunities between now and tax filing season. And we would generally say, they're reticent to make changes right in the heat of tax filing season. So, if we don't see some movement on this in early January, it's pretty. I'd say that the outlook gets even bleaker out into the future. So that was kind of when I'm thinking about the near term, those legislative updates. But it's really important to kind of pick our head up and look at what's on the horizon a few years out. So I'd like to put this out here and say the tax cliff cometh. So in 2017, the Tax Cuts and Jobs Act brought around a lot of great tax savings, and you can and tax opportunities that are listed over here on the left of your slide. Some of the key ones that came about: the individual tax rates dropping, highest marginal rate dropping from 39.6 to 37%, and that great 20% pass-through deduction for qualified businesses. So that's been very lucrative for our contracting base. The corporate rate for entities taxed as C corporations, went from 34% down to a flat 21%. And again, we were handed some pretty generous bonus depreciation and immediate expensing. And so you can see here the calendar, the blue cells are, that those laws are still in effect. And you can see starting 1/1/26, we've got some serious reversion and loss of tax breaks that will revert back to what it was prior to the Tax Cuts and Jobs Act. So the individual rates snapping back up, loss of the 20% pass-through deduction. And you can see that we're going to talk about bonus depreciation here in a little bit. So, really important to have this on your horizon, especially as we're talking about tax planning opportunities. And, when we get into methods of accounting, we look at depreciation elections and, some of the ability that we have to, typically a deferral strategy is we're accelerating to all the deductions we can today, and we're trying to push taxable income out into the future to pay taxes later. But this tax cliff is really important to keep our eye on because, depending on what your predictions are with this tax cliff, maybe reevaluating some of the deferral strategies because there's the potential of pushing income into higher tax years or not saving the deductions for when they could be more valuable in 2026 when these tax changes come about. So with that, our first polling question for folks to get their CPE. So, what is your prediction for the tax cliff that's going to happen at the end of 2025? Do you think the tax provisions, the TCJA will be further extended? Are you in one of the beliefs that the tax cliff cometh and these provisions are going to expire, or some type of mix where some provisions will be extended, some will expire, really be more kind of a pick and choose from Congress? So please take a minute and go ahead and answer these to make sure everyone gets their CPE credit. Okay, we'll give it about another few seconds, and then we'll keep this moving along. Okay, so we will close the poll and see what are the outcomes. So it seems the clear winner is a mix. Some provisions will prevail and some will expire. So I think that's a very plausible outcome. So moving on to 2023 tax changes. What's the law of the land that's different from before that we need to keep our eye on, that we'll be contending with this filing season coming up soon? So, I've mentioned before around depreciation changes. So we are in the first year of the phase down of bonus depreciation. So for 2023, we went from 100% expensing on qualifying assets down to 80%. And you can see this is going to start phasing out 20% per year. And without further action from Congress in 2027, there will be no bonus depreciation. There is a little bit of a saving grace here for certain taxpayers. While bonus depreciation is on a phase out, Section 179 was made permanent a few years ago. So Section 179 allows you to immediately expense up to $1,160,000 for the 2023 tax year, as long as your CapEx doesn't exceed just shy of $3 million. Now, 179 functions a little bit different than bonus depreciation. There's a couple limits to it, so it's maybe not as advantageous or as attractive, but it's still out there. Encourage you to work with your tax advisor to see, obviously, how does this fit into your tax strategy, and which is the best mix of Section 179 versus bonus depreciation for you. There's a change to how the deductibility of meals for 2023. So we had a little bit of a tax break for the last 2 years, some COVID provisions that allowed the 100% deduction for meals as long as they were paid for and incurred at a restaurant. Again, Congress trying to give a break and incentivize people to go back out and spend money at restaurants. This has expired. So in 2023, our current tax year, we're back to the old rules, which is generally 50% expensing, 50% deduction for meals, except for there's a few items that still qualify for 100%. But the key thing to note here is that that meals paid to a restaurant provision has expired. Just a note, I know typically meals and entertainment kind of get lumped together, but just as a reminder, meals and entertainment have different tax treatments. Entertainment expenses are just generally non-deductible except for a few exceptions. So if you have that account that says meals and entertainment, I'd encourage you to bifurcate those, have an entertainment account, have a meals account, so that help your CPA figure out how to treat those. But of course, there are a few circumstances where you can deduct all of your entertainment, if it's entertainment related to your holiday party. Those are some examples where there's still ability to deduct entertainment expenses. Okay, on to everyone's favorite topic when it comes to the employee retention tax credit. So again, this was a big deal, and I know this has been a huge tax incentive that many of our clients have pursued, and pretty much everyone went after this tax credit one way or another, which is what caused a little bit of some of the issues that we'll talk about. So just as a real big picture overview, again, I know most people are familiar with this credit, but it is a refundable payroll tax credit for businesses that meet one or two qualifications. So either you had a gross receipts reduction, and this credit was around in 2020 and the first 3 quarters of 2021. So you're looking at each quarter for either 2020 or 2021 and comparing that to the same quarter in 2019 to figure out if you met the requisite amount of gross receipts reduction. So in 2021, the more lucrative year for this credit, you had to have gross receipts that were a 20% reduction when comparing the comparable quarter in 2019. The amount of the credit was pretty lucrative in 2021, up to $7,000 per employee per quarter should you qualify. So again, a lot of dollars at stake here. I like to think about the gross receipts reduction, that's pretty right down the middle of the fairway. That's a math test. Either you make it or you don't. Not a whole lot of risk in there as long as you're accurately calculating your gross receipts. But the second qualification is, I think, where some people may have gotten tripped up, but there's been guidance was not properly analyzed, or you had people with differing opinions, and that came down to the partial suspension of business operations that were mandated under a government order. Again, not as straightforward. And again, there's been a fair amount of misinformation that's been out there around this, which has led to kind of some of where we're at with the IRS's position when it comes to the ERTC. So, there have been some pretty bad actors out there, promoters for ERTC. We're calling them credit mills. People who, groups, entities that would just, really didn't matter. If you didn't do a whole lot of due diligence when it came to your qualification. And so the IRS was trying to, give warnings and let people know about these kind of bad actors. This may not mean a whole lot to you, but it means a fair amount to us in the tax profession, that this, the ERTC made the IRS's dirty dozen list. So that's a list they come out with some of the shadier tax positions, or where that they are really trying to focus in additional scrutiny. So, some of the IRS, some of the warning signs around, again, this kind of led us to where we're at today. The massive amounts of just advertising, unsolicited ads, calls, people reaching out constantly around this. I mean, I can't drive to work even still without hearing an employee retention tax credit ad on the radio. My kids know what the ERTC is because they hear it on the radio when we're driving them to school. And my son's like, "Dad, what's the ERTC?" So, I mean, people have been out there and really aggressively promoting this, trying to get your business with with arguably maybe not doing all the requisite diligence again for do you properly qualify. So with the kind of massive rampant fraud that's been out there, or just again questionable positions related to this. The IRS first started with trying to inform taxpayers, and now we're at a point where in September of this year, they announced a moratorium. So the IRS said they are not processing new claims for the ERTC. That was effective immediately in the end of September. And the moratorium was put in place at least until the end of December of this month. So a pause. They may extend that. It's yet to be seen. But they're saying, I guess you can submit these things, but they're just going to go in some, God knows where, some back office until we're not going to process them. We're not going to do anything with them until the moratorium lifts. They also announced in September, that they were going to be implementing a settlement program. So to the extent that you maybe took an aggressive position or got caught up in some of the aggressive marketing and aggressive promoters, they announced that they're going to come out with a program for you to be able to withdraw your ERTC claim and pay back the government, and trying to get ahead of, potential audits, and that the IRS is aggressively staffing up to audit these. It's one of their priorities. So again, they're trying to give taxpayers an out to the extent they feel like they took a credit that they shouldn't have. So a month later, we kind of got the next wave of news in October that says that they came out with a withdrawal process. Now, this is a little bit narrower. They gave a procedure for taxpayers to withdraw their employee retention credit claims, under a certain few circumstances. First, that you made the claim under an amended tax return. When you amended your 941 to claim this, that was the only thing you changed. So you couldn't have had another error or something else that you were accounting for on that amended 941. You want to withdraw the entire claim. You can't use this provision to say, well, I was off a little bit, or I was off for, again, you want to back out of the entire claim. And, and this is the harder one that, either the IRS hasn't paid it, so you submitted it, but you're still waiting on processing, or they sent you a check and you haven't cashed it. So if you fall into those, that set of facts, there's a withdrawal procedure, and we're still waiting on more guidance to see, again, if you had already cashed the check, what's the kind of the settlement program that they're going to come out with. So the key thing that I want you to walk away with here is evaluating your ERC to the extent you took it. Again, if you're in the math test, if you're in the gross receipts, again, I think you're pretty right down the middle of the fairway. But to the extent you use the partial shutdown, and depending on, I would revisit the due diligence for this and see, do you feel comfortable with the claim that was made? And if not, get another second set of eyes on it, and have someone else review it who, again, not from one of these credit mills, talk to a competent tax advisor and get their opinion on the validity of your claim. And then at least then you're armed with some information to see, do you want to pursue a settlement program to the extent it comes out? Do you still believe in the position? And just kind of getting yourself maybe a little more audit ready to the extent that they come around and want to look at your ERC claim. So next polling question. So how many solicitations did your company receive from third-party providers related to the employee retention credit? So, I got a couple calls here and there. I got multiple calls per week, or my phone was ringing daily to the extent that I strongly considered changing my phone number. Again, I'm curious to see how this. A friend of mine who's a CFO as a contractor, when she left on vacation, she left on her voicemail specifically that she was not interested in any ERC solicitations or promotions. Please do not leave your name and number. Please do not call back. We are not interested. So just because I keep hearing from my clients that they were just bombarded by this constantly. So curious to see everybody else's level of engagement with how many times you were called. So we'll give this about another couple of seconds. So if you are trying to get your CPE, please make a selection and we will go ahead and close the poll. So looks like actually the winner was a couple here and there. So good to know that, but it looks like about 20% of the respondents thought about changing their phone number. So we'll move on. So another tax benefit that we want to talk about is our research and development for contractors. Now, this really has two components that we're going to talk about today. So we have the R&D tax credit, which several of our contractors have successfully pursued. It is a great benefit out there. That the research and development tax credit has not changed. Some other changes, again, to the cost side of things, but the credit hasn't. So as a real quick reminder, the tax credit is for qualifying costs to the extent you have research and experimentational expenses, and you meet a four-part test. So your R&D needs to be involved in eliminating the uncertainty in a project. Has to be through a process of experimentation. You've got to have some iteration. You have to have some experiment. It's got to be, based in technology, as opposed to, doing R&D for, management consulting or some type of functions. Again, it has to be technological in nature, and it has to be for a qualified business purpose. And ultimately, the contractor has to bear the risk of that R&D. So, to the extent your jobs and your costs meet those, there's the potential to get an R&D tax credit, which generally shakes out to be about 5 to 10% of your costs equate to a credit. And the credits are great because they offset tax dollar for dollar. So again, what are some R&D? What can this look like? A few things. Designing processes and techniques that result in increased efficiency, quality, or performance. Again, this doesn't have to be new to the industry. Something no one has ever done it. This has to be new to your company, something you have never done before. We think about design build contracts that are, involving innovative concepts or components, a lot of prototyping, modeling, systematic trial and error. These can all be symptoms that you are doing R&D, and could potentially pursue a credit to the extent that was beneficial to you. Some examples of activities that we'll see in practice for our contractors: development of unique energy efficient features, development of innovative designs, bridges and roadways, designing foundations and earthwork for site conditions that are very unique, something you haven't encountered before. Again, the key thing here is that you haven't done it before. You are trying to iterate. You're trying to increase your procedures, your efficiencies, and do something new. So again, to the extent that you have these type of activities, there's a potential tax credit out there for you. I always like to keep this as kind of a constant bullet point on year-end planning, because you can do R&D in one year and not have it the next year, or vice versa. So it's always something to be aware of. And that gets to be a little bit more important, again, when we talk about the other component of R&D. So we just talked briefly about the credit. The other side of it is just the costs. So again, the costs have a different treatment starting in 2022. You can still qualify for the credit, but the costs that go into that credit have a different treatment now without further action from Congress. So they are, as I mentioned before, capitalized for tax purposes only, capitalized and amortized over 5 years if it's U.S. based R&D, 15 years if it's foreign. And some important distinctions here when you're talking about the identification of those costs. So to the extent it is a general R&D, so it's specific to your company and not applicable to a specific contract, then that's going to be general R&D. That's going to fall under the I've got to capitalize that and I've got to amortize it. A real important thing just to make sure that we call out here: the treatment of R&D costs is irrespective of whether you are pursuing the R&D tax credit. So we've been down this road a few times where we'll look at it and there's some R&D, but overall it's not as material. The amount of work to substantiate the R&D study, it's real close on a cost-benefit analysis to pursue the credit and the substantiation, the documentation that's required. So we'll run into times where contractors will pass on taking the credit. Well, under this law, it doesn't matter if you're taking the credit. If you have those expenses, whether or not the credit is beneficial or not, you're required to go through this capitalization exercise. So again, how we're treating the costs is different than the calculation of the credit. So to the extent you have R&D or research and experimentation costs that are allocable to your long-term contracts, last year when we were going through filing season, again, this was effective for 2022, there was a lot of confusion about how this was going to apply to your long-term contracts. Then the IRS, in typical IRS fashion, gave us guidance on September 8th of 2023, just 1 week before the extended due date for most of our contractors, where they gave us some interim guidance, said proposed regulations will be coming, but it really kind of showed us that how we're going to treat the costs and how they impact your percentage of completion for tax purposes. So really the current year amortization of those costs go into your numerator, and your total estimated costs and your total R&D spend, estimated spend for that contract go into your denominator. Now, there's definitely some complexities in here, and the way that it's worded right now, there's definitely a potential for a mismatch of income versus the deductions related to this when you're thinking about how the percentage of completion works. We won't go into all the details here, but this is something that just to make sure that you're aware of. To the extent you have research and experimentation expenditures, again, irrespective of the credit, how are those going to fit into your long-term contracts? And again, to plan for that, because when you work through it, there's a chance of accelerated income in 1 year, deductions in the later year, and a little bit of a whipsaw potential when we're looking at the percentage of completion. So another quick poll. So just to take a quick survey for our audience. Are you currently taking advantage of the R&D tax credits? Yes, I am. No, I'm not, or not applicable. You fall into the category like my wife, who is actually logged into this webcast, who has been a little bit negligent in keeping up with her CPE. So not only does she have to listen to me talk about taxes when I get home from work, she's listening to me present about this right now. So if that's your boat and you're here for the CPE, NA would be your answer. So we'll give it another few seconds for people to wrap this up and to get their CPE, yes, no, or NA, and we will see where it shakes out. Okay, closing the poll. All right, so we've got about a third of us are here for CPE. Great to see you, and we got 20% saying yes, and about 45% not taking it. So, again, year by year distinction to the extent you have R&D. Even with the capitalization requirement, there's still some overall tax benefits to consider when you're looking at the R&D tax credits. So talk to your Moss Adams professional and see if it makes sense for you. Okay, so moving on. So there's 2 items here that were enhanced credits and deductions that came around of the Inflation Reduction Act, and some changes to those. So again, I want to make sure you're aware of what's out there. So the first is Section 179D. So 179D has been around for several years, and it provides a deduction, not a tax credit, but a deduction for building energy efficient commercial buildings and certain residential buildings to the extent they're greater than 4 stories or more. So if you are in the designing these, under the old law, which is before 2023, so that's where we kind of draw the line in the sand. So we have different deduction amounts, different qualifications. They used to be $1.80 a square foot, index for inflation, and for the size of the building that you were working on. But there's also some partial deduction ability. So you were able to carve out sort of different building systems. There's a deduction if you're just doing the energy efficient lighting and making upgrades there. There was if you're just working on the HVAC or just the building envelopes, and there's a few different buckets that you could fall under, and as you'll see here in a second, that has changed. So before the Inflation Reduction Act, it was a little bit more limited for who was able to benefit from this deduction. So commercial building owners and designers of buildings owned by government entities. And this right here is really the crux of where the benefit has come around for our contractors. So if you were in the design process, you're doing a design build contract for a government entity. A government entity has no need for the deductions. They're a tax exempt entity. So they were able to assign that deduction to the designer. So again, it was a cashless deduction that you could get if you were the one that they assigned the deduction to. After 2023, you'll see that there's more projects that can qualify. So not only is it government entities, but they've also expanded the list to include nonprofit entities, churches, tribes, nonprofit schools or universities. So an expansion of the projects that you are able to be able to assign the deduction. Now, nothing really has changed on the assigning the deduction. Candidly, sometimes it can be a little bit of first come, first serve. Who gets the owner? Who do they assign the credit to? Sometimes it can be allocated to a couple different people, but we joke free candy can only be given out once, so you can only just assign the deduction in its entirety once. So, and you have to be in the design portion of this. So if you're in design build will work. If your contract language disavows all responsibility for any of the design work and you're really only doing the construction or the assembly, then that would be a bad pattern to qualify for this deduction. So not only did the amount, kind of what projects qualify, change, but the benefit changed. So in 2023, the base deduction, sliding scale, starting at 50 cents a square foot up to $1 a square foot, 50 cents a square foot if you meet the 25% energy efficiency standards when comparing it to the kind of the standard baseline that they prescribe under the ASHRAE standards, and up to $1 a square foot if you get up to 50% or greater energy efficiencies. But they added in what they're calling the bonus deduction. So that 50 to $1 changes from to $2.50 up to $5 a square foot if you are using, your contracts have prevailing wages and you meet the apprenticeship requirements that are put out in the Inflation Reduction Act. Now, this has been kind of a point of contention. There's been guidance has started to trickle out. We're still waiting on more guidance for kind of in the details of prevailing wage and apprenticeship. But I would tell you there's a and we've highlighted it here. If you had a project where you had shovels in the ground prior to January 30th of 2023, you are just deemed to have met the prevailing wage and apprenticeship requirements for 179D, and you don't have to go through the substantiation effort. Again, that was based off of when they came out. They gave a little bit of a grace period when they changed the law. So things to be aware of. Again, this can be a pretty lucrative deduction. As you'll see here, we compare a couple of projects pre-IRA and post-IRA, assuming maximum qualification. So you can see on a 50,000 square foot office building, it used to be worth a $90,000 deduction. Now it's $250,000. Or on a $500,000 warehouse, $900,000 deduction pre-IRA. Now you're talking about potential for $2.5 million deduction. So definitely became a more lucrative tax deduction that's out there, and want to make sure contractors are aware of it to the extent they're working on these projects and can get these deductions assigned. We'll just talk about this one real quick at a high level. This predominantly, Section 45L, predominantly we see this a lot in our home building clients. So this is a tax credit that under the current law can be anywhere from $500 all the way up to $5,000, depending on what, again, the prevailing wage requirement and what level of energy certification that you are working towards. But to the extent you're building a home, a single family home that is for sale, or building a single family home, or a multifamily complex that's for lease, once you're, again, either for sale or for lease, you can't just be the contractor that ends up not owning it. You've got to be the owner of the property or the seller of it. Again, there's some lucrative tax credits out there for our home builders. So to the extent that this may be an opportunity for you, again, there's a lot of details here and kind of how the qualifications for the different energy standards work. I'd encourage you to reach out to your Moss Adams professional and see to the extent this opportunity can be realized for you. So moving on, near and dear to my heart are methods of accounting for tax purposes. And again, lots of opportunities here for contractors because there's multiple different methods of accounting you can employ in your business. So when we take a step back, we remember that all taxpayers have an overall method of accounting. You can be a cash basis taxpayer to the extent you qualify, an accrual basis taxpayer, or there's a few hybrid methods. Again, that's your overall method. And then we kind of move along the scale and say we have a specific method of accounting for our long-term contracts. And again, it's important to remember that under the Internal Revenue Code, a long-term contract is any contract that spans 2 tax years. To the extent you start this in December and finish in January, you have a long-term contract, assuming a calendar year end. You start this in January and finish in November, calendar year end, you have a short-term contract. So again, anything that spans a tax year will be considered a long-term contract. So next we kind of look at, do you meet the small contractor exception? So a small contractor is measured based off of your gross revenue. So if you, and this has been indexed for inflation, so for 2023, to the extent that your if you look back your prior 3 tax years, if your average annual gross receipts are less than 29 million, you are considered a small contractor. And so that unlocks a certain set of accounting methods that you can use for your long-term contracts. You can see some of the examples here: cash, completed contract method. You can still use the percentage completion should you choose, should that be advantageous to you. But again, you're not required to use the long-term contract percentage completion accounting for regular tax purposes. You have to use it for AMT, which is a big pain. But for your regular tax, again, you have, to the extent you're a small contractor, you've got some more options. Since you're a large contractor with average revenue over 29 million, again, you have a different bucket of options that you can use. Generally, it's the percentage of completion method. And then there's a few other ones that we're going to get into here in a minute. But the moral of the story here is that I want you to walk away with: this is determined on a contract by contract basis. You can have many different methods of accounting in your job schedule. Again, it really takes a good analysis of your contracts and working with your tax advisor to see what qualifies, what makes the most sense. And there's a whole bunch of mix and matching here. So civil contractors with multiple different methods of accounting for different contracts on their schedules. So cash method, again, to the extent that you're qualify for as a small contractor, you can use cash for your overall method and your long-term method. If you're a large contractor over 29 million, your overall method could still be cash, except for your long-term contracts. So your long-term contracts would then be accounted under percentage of completion, or one of the offshoots we're going to talk about here in a minute. Again, so this is great. If you're, I have several electrical contractors that are on the cash basis because their receivables are always well in excess of their payables, and it makes a really good tax deferral method to put those receipts on the cash basis. So a couple things always to remember is that to the extent you're required to use the percentage of completion, and we have a couple of exceptions here. So the first is for our home construction contracts. Those are just completely exempt from the percentage of completion. So that is when you're building a structure where 80% or more of your costs are to build that structure, and that structure has 4 or fewer dwelling units. So single family homes, duplexes, townhomes, etc. These are completely exempt from the percentage of completion. Great method for these can be the completed contract method, where you're putting all of your taxable profits in the year of completion. There's no AMT adjustment, and you're excluded from the requirement to do look back, which is great. And then we have, again, to the extent you're required to use percentage of completion, and you're working on residential contracts. So residential is the same thing as a home contract, except the building has more than 4 dwelling units. So think about your apartment complexes, think about barracks, dorms, even prisons can qualify for this. This has a special method that ultimately, it shakes out that you can take 30% of your contract and you can put it on a different method. Completed contract is a great one for this. And then your other 70% is on the percentage of completion. So this essentially just allows you to defer 30% of your profits until the year of completion, to the extent you're working on these type of projects. So 2 ones we'll talk about here that are good for general contractors: the percentage of completion excluding retention payable. So under this, to the extent you have retention that's payable to your subs, for tax purposes, considering that payment of that requires another event, they have to do X before the retention is released. That retention can be is not considered a cost that's incurred because all events haven't happened to secure your obligation to pay it. So if you think about that for your percentage of completion method, then you take out that retention payable from your numerator in your percentage completion calculation. So your percent complete for tax is less complete than it is for GAAP basis, builds in a little bit of a tax deferral. Again, you need to have the appropriate wording in your contracts to make sure that that you truly don't have the obligation to pay that retention until certain events have happened. So now we take this one step further. So another great method, and we've been working on this for, this has been around and got a lot of traction in the last 4 or 5 years, is the percentage of completion excluding not your retention, but your entire subcontractor payable. But you have to be operating, your job has to be in a state that have paid if paid clauses, and you have to have the appropriate language in your contract. Here's an example of some of the language you'd like to see. The contractor's receipt of payment from the owner is a condition precedent to the contractor's obligation to make payments to the sub, and that the sub is assuming the risk of non-payment from the owner. So if you have that and you're operating in a paid if paid state, then this can be a really, really big tax deferral, because you're taking out everything that's payable to the subs at the end of the year and backing it out of your percentage of completion for tax purposes. So paid if paid, are they allowed? I'm not an attorney, but if you look this up, there's 12 states right now where paid if paid clauses are not enforceable. So to the extent you're operating in one of the states that's highlighted in red there, you would not be able to use this method of accounting, because paid if paid is not, not enforceable in those states. So another polling question quickly for everyone to get your CPE. Do you review your tax methods of accounting annually as part of your tax planning? Yes, no, or you're like my wife who's here for the CPE and you just thought construction tax would be a great thing to listen to this morning. So we'll give this a quick minute. So please go ahead and respond to the poll so we can make sure you get that CPE, especially as we're getting towards the end of the year. And if it's your renewal year, you got to make sure you get these in. So looks like we got about 70% of people responding. We'll give it a few more seconds. So go ahead, click yes, no, NA, no right or wrong answer, but just to make sure that you get your required CPE. Okay, closing the poll. So that's great. Almost half of you do review this as part of your annual tax planning. That's fantastic. Again, always keeping in mind what your contracts are and is this the right method for you? So a couple other provisions just to touch on briefly here that, again, for planning purposes, you've heard these before, but a quick recap. We have the qualified business income tax deduction that, again, gives that generous 20% deduction for your qualified income. So really the thing to walk away from here is making sure you're evaluating all payments that are made from the entity to the owners, because that can impact the calculation and the ability, for how much qualified business income tax deduction is available. So if you're an S corporation, the amount you put on your wages, to get in your salary, that what goes on your salary is not qualified for the QBI deduction, but what comes through on your K1, again, assuming all other qualifications, that would qualify for it. So again, looking at that relationship between reasonable salary on a W-2 and versus distributions out of your S corporation. Again, if you're structured as a partnership, same kind of thing. Instead of a salary, you're getting a guaranteed payment. Guaranteed payments don't qualify for QBI, but your distributed share of income on your K1 does. So, we've looked at a few operating agreements that maybe had some flexibility, or we did some amendments to reduce the amount of guaranteed payments and have special allocations of income to be able to put more taxable income into the qualifying bucket and out of guaranteed payments. So again, a couple things to think about. Always remember that if you had losses in a prior year, you have QBI loss carry forward. So just being aware that if you're planning for your year-end tax planning and you're thinking about your income, you do need to net that and think about what you had in the prior year. And again, this is one of the big ones that's going to sunset right now with that action from Congress at the end of 2025. So, ultimately, how are you thinking about your tax deferrals? You take depreciation, for example. Do I want to defer taxes, take that depreciation now? or do I want to save that, elect out a bonus or 179, raising my taxable income? You raise your taxable income, you raise your 20% deduction, and arguably you're saving deductions that would be realized when the QBI phases out in 2020, the beginning of 2026. So just a planning consideration to think about. Again, to the extent the interest rates are rising, so your business interest expense is becoming more material. Just the thing I want you to walk away from here is that who qualifies and who can be exempt from the business interest expense limitation changes. In 2022, if you had less than $27 million of annual average gross receipts, this didn't apply to you. It's at $29 million for 2023. So just keeping an eye on whether this, did you qualify? Were you subjected to these rules? Will you be subjected to these rules this year based off of kind of how the inflation adjustments work? And then there is an election that you can make to be out of these rules, but it comes at the cost of losing some ability to take accelerated depreciation of some of your longer-lived assets. So just bring this up as far as, again, to continue to evaluate and make sure this doesn't surprise you. And the last one, excess business loss limitations. This is kind of the Grinch provision that I mentioned earlier. So just to be aware of it, to the extent you have pass-through losses, so partnerships, S corporations, and you kind of net that together, your net flow-through income, to the extent that's a loss, you can only use that loss to offset other income up to $270,000 if you're single, $540,000 if you're married filing joint. So Santa can come bring that big 179 deduction and get to that $2.5 million deduction, but the Grinch is going to come and hit you with the excess business loss limitation and only let you deduct so much of that against other income, and then whatever you don't use kind of gets converted over into net operating loss and carried forward. So just something to be aware about in year-end tax planning, year-end projections. So a couple quick updates, just a few high points here, what's going on in the Internal Revenue Service. New commissioner came in, Danny Werfel, and he has a really interesting background, but has been really trying to modernize the Internal Revenue Service. And he came out with their strategic operating plan in April of this year, which really was, how is the IRS going to spend that $80 billion that it received? And renewed the call that we're not going to raise audit rates for people making under $400,000. But the key thing to take away from here is this is how they plan to spend it. And you'll see the vast majority of that, $47 billion, is on enforcement. And then the next closest priority is $12 billion looking for technology advancements. The key thing to know here, I know in May of this year, there was kind of a verbal agreement between the president and the then speaker to claw back $21 billion or so of this and to reappropriate those funds. And it seems like the IRS funding is a constant hot button for, did they get this money or did they not? The thing to walk away was that they would just adjust this pro rata to the extent they don't get the full $80 billion. Two other things that I just want to highlight on is that what we're seeing in audits, anything related to tax credits is getting a lot of attention, and then for our high net worth individuals, this is where they're targeting. They came up with the Wealth Squad to go after well-heeled individuals, increasing the audit rates. A lot of data analytics have been starting to be used. The IRS was touting their investments in AI, and that by using AI, they recovered $160 million by increasing audit rates. And the thing that's probably the most important to our group here, just to be aware of where they're spending a lot of time looking at, is material participation. So the determination if you're active or passive in an investment. So the key thing to walk away from here is that you're consulting with your advisor. Really documenting how you're arriving to material participation, which is generally over 500 hours in an activity, keeping notes contemporaneously, and looking at the elections that did you do those correctly if you decided to group certain entities together? The IRS has the upper hand here. They can just look at this and say, all right, taxpayer, prove it to me how you materially participated, and then the burden is on you to substantiate that. So this is a big hot button audit issue, so wanted to share that with you. And looking at the time that we are just about wrapping this up, so in summary, look at what's over the horizon, look at what the tax legislation is we chatted about. You develop a playbook. What are we going to do in the short term versus the long term? Always understand your methods of accounting. Almost half of you seem to be looking at that annually, so that's great. If you haven't gone after the ERC, be wary. And if you have, maybe it might warrant another look. And be audit ready now, because there are more IRS audits to come. So with that, thank you so much, and I will turn it back over to Amy.
All right. Well, thank you, Michael, for a really great presentation today. And to our audience, if you have further questions or comments, please reach out to us and we would be happy to continue the conversation. You can drop a note in the Q&A window or reach out to Michael directly. His contact information is in your console. And if you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks as well. And finally, here's a link to a survey for today's presentation. Your feedback is always appreciated, and thank you for joining us. Take care, everyone. Thank you, Michael.